Investing has been really good. In fact, it's been pretty easy over the past couple of years. Look at the stock market go up over the past 5 years, especially the past year. It's been going up with very minor volatility. But a lot of people believe that valuations are stretched, there's too many risks, and the stock market has reached a tipping point. So let's go ahead and do a little economic update. First of all, buybacks reached an all-time high. They hit a record in the S&P 500 since 2020. With companies being infused with low interest rates, they can borrow money cheaply and they can issue share buybacks. The record high buybacks this year have been instrumental in increasing stock prices. Not only have buybacks reached a record high, dividends reached a record high. The amount in total dividends paid last quarter was the biggest amount of dividends ever paid in the S&P 500's history. Now you'd think that this would cause the yield of companies to go up as companies are paying higher and higher amounts of dividends. But that's not the case. Yields remain low because stock prices have outpaced the speed of dividends and buybacks. Charlie Munger recently said that stocks are overvalued. They're even crazier than the dot-com bubble. Inflation is surging. The official report is that it's at 6.8% in November. The last time we had inflation at 6.8% was in 1982. There's many notable investors that are concerned about inflation. Bill Ackman is one of them. He says the official reported inflation is understating the problem, and the real inflation is at 9 to 10% right now. Jeremy Siegel says that we're one more bad inflation report away from a correction. Ray Dalio is also concerned about inflation, saying that the US is on the wrong path right now. Michael Burry has been warning about hyperinflation for a year now. Paul Tudor Jones twice now has publicly said that inflation could be worse than feared, and it's the biggest threat to the markets and society. Mohammed El-Aaron says that calling inflation transitory was likely the Fed's worst call. Now, there is one notable standout that doesn't believe inflation's a problem, which is Cathie Wood. She has dismissed inflation as a problem so far. It is worth mentioning, though, that her portfolio is full of companies that would be discounted further with high rates of inflation or with increased interest rates. Now, the White House has admitted that they have misjudged inflation, but their official prediction is that inflation will be around 3% by the end of 2022. So they're expecting 3% inflation readings in a year. But in the meantime, even transitory inflation has pretty dramatic effects. Even though we see wages rising, they're not rising at the rate of inflation. Total private wage growth has struggled to keep up with prices. And we also have the issue of tapering. If the Fed stops buying bonds and they have to increase interest rates in the future, that can cause a temporary taper tantrum, and raising interest rates historically have not been good for the markets. Now, even outside of the concerns of the market hitting record highs and inflation, we also have the Omicron variant to worry about, and we have the first official death in the United Kingdom. This will be further negative news passed around, and this likely will affect stock prices while it's making headlines. So in this episode, I want to go through what I plan on doing in this type of environment. Now, if you like this type of content, make sure you subscribe to the channel. That always helps out the metrics, as well as if you really like it, you can check out the Patreon. You get access to a private Discord community, exclusive episodes and AMA sessions. The Patreon also includes Qualtrim Track, a dividend tracking software, and Qualtrim Insights, a stock search tool that gives you all the fundamentals of your favorite companies. All of this is included with the one Patreon membership. So try it out risk-free. There's a link in the description. Now, I want to go over what I'm doing in this situation with all this news of a tipping point in the market. And what I'm doing is pretty simple. What I'm doing is just investing in the best companies at the best valuations, and Apple is one of them. I'm currently in the green by $24,000 in Apple. I've been told that this company is overvalued for years now. Going back over a year, I've still been told that this company is overvalued, but Apple continues to perform incredibly well. Apple has appreciated 37% this year, and the stock price is nearing 180. Now, I don't see this price momentum with Apple slowing down anytime soon, and Gene Munster, one of the Apple analysts that so far has been very correct on this stock throughout its history, doesn't see it either. He believes that this company will become a $200 company, and he explains the potential of these new projects they're working on.
And in particular, investing in Apple is related to predicting what's next. And in Apple's case, they have had these what's next every 5 years. They've reinvented themselves, whether it be the iPhone, services, and here we are at the cusp of yet another reinvention, potentially 2 reinventions. And that's why I remain optimistic. I believe that the company's best days are yet to come.
He mentions that their best days are yet to come, but he also mentions 2 new markets for Apple.
Core business is predictable. It's having a headwind with the supply issues that we can talk about. But really fast forwarding beyond those supply constraints is that the 2 big opportunities for the company are centered in the metaverse and autonomy. The metaverse is going to be real for Apple. They will have hardware. We think that they will preview in 2022 mixed reality goggles. It's going to take years for these to become mainstream, But again, investing is about what is coming next, and that is something that can be material to Apple's business. And then, of course, there's auto and autonomy, and I'm cautious about endorsing this theme too much, given my mistakes around the television in the past, and seeing what Apple works on doesn't necessarily see the light of day. But if I can just quickly frame in the auto opportunity, is that they have 20% market share on mobile today. If they get 10% in auto, that's a $540 billion business. They're going to do $380 billion next year. I mean, this could be massive for them. Again, caution, we're years away, but the point of investing is to be in front of these curves. And when you put it together, to have that optionality and trading at under 30 times, I think is a bargain.
The two new categories of products that Gene Munster's focused on is augmented reality, which he thinks will come out late 2022, and he also believes that Apple has decent potential with the auto industry, with the Apple Car, and that would be another massive market for Apple, even if they only took 10% of the market. So they'd still be sharing the market with Tesla and other auto leaders, but even if Apple got a small portion of that market, it would be a huge portion of their business. Now here's the part that I think is interesting. This analyst is actually more bullish on Apple than I am. She asks him, would Apple still be a good stock at today's valuations if you didn't have augmented reality or the Apple Car come to light? What about if those things don't happen?
Well, you have a core business that can backstop you to $200. My previous price target was $200 that excluded the multiple expansion on the metaverse and what can potentially happen around autonomy. So to answer your question, Morgan, is that I think that there's upside based on the core business. This is related to the accelerating digital transformation. They've had some, I would call it wins recently in the courts regarding some of the steering and around services. I think when you put that together, this is still just a sleep well at night company and should be $200. But then it begs the question, do you own it from 180 to 200? That's a decent return. But for the real upside to kick in, I need to be right on this, that they need to get into one of these two. I feel with high conviction that they're going to do something around mixed and augmented reality and glasses in the years to come. And I have high conviction, despite my apprehensions about the world of the metaverse, that it is the future. And then, of course, the car. So to answer your question, Morgan, is if I'm wrong on both of those, I still think there's upside to the stock.
So he thinks Apple's a $200 stock, even if it doesn't have the metaverse or the Apple Car. They can still trade around 200 in their existing category. When I do research on Apple, or Microsoft for that matter, inflation never really comes to mind. It's not something I even incorporate in my research. I do valuations, I look at the company, I look at the fundamentals, I look at the story of Apple transitioning from a hardware business to a service and subscription-based business, of Apple pushing into media with Apple TV+, Apple's opportunity to help in healthcare, the metaverse being a potential new category for Apple, and even further out the Apple Car. I'm not concerned about inflation when I'm judging Apple. They can price their products and subscriptions at basically anything they want. If inflation goes up, the prices of their products will go up. And it's the same with Microsoft. I'm not incorporating inflation into my analysis of this company. In the consumer category, Costco's another company that I just did a video on, calling it the best company in the world. They just reported their earnings, and the earnings were about as good as they can possibly get. Their total revenue grew 16%, beating estimates. Their earnings grew 14%, beating estimates. Costco is still growing their earnings around 15% year over year. This is incredible earnings growth. Their sales growth was also positive in every market, in the United States, Canada, international, and e-commerce. In the past quarter, they also gained 1.5 million new members, beating estimates, and half of them were executive, which are the higher paying members. And their churn rate actually went down, meaning that less people are canceling their Costco membership. So Costco's another core conviction. It's pretty high price right now. I'm not buying the stock currently, but it's one of the companies that I'm not concerned about inflation with. They have a lot of ways of handling inflation. A category that would get hit really hard if we had hyperinflation, or inflation continue at 7 to 10%, is probably the real estate category. Triple net leases are probably not the best investments during high inflationary times. It's true that some of them have CPI adjusted rent increases, but those are only by like 2%. So if inflation runs really high, 7 to 10%, companies like Vici or Store Capital or Realty Income Corp simply can't increase their prices at the rate of inflation. So buying these long-dated leases are similar to buying long-dated bonds. They really aren't the best option right now if you think inflation is going to run really hot for years to come. So some categories of my portfolio will stand to benefit from inflation, some will actually suffer from inflation, but overall it's not something that I focus on when I'm doing analysis. I really think that if you're investing in the best companies and hold them for a long period of time, you don't have to worry about the macro events. At the end of the day, most companies companies trade on their earnings. This is what's important, their earnings and their future outlook. If a company can grow their earnings 15% plus year over year, that company is going to go up in value unless it has a terrible outlook. The earnings of a company drive its stock growth. So I'm focused on companies that will continue to grow earnings in any environment, and I really think those companies will be the long-term winners. But maybe you have a different strategy. If you're doing something different to prepare for 2022, let me know. But that's all for today. I'll see you in the next one.